When a startup says they're raising venture capital, that could be a startup that has two co-founders seeking to raise 1 to 1.5 million in a pre-seed round, their first institutional capital ever. But when a startup says they're raising venture capital, that startup could also be a company with over 1,000 employees looking to raise hundreds of millions of dollars at a multi-billion valuation. Now, while these rounds are both venture capital, of course, they require a different approach, a different pitch strategy, generally different folks in the room to begin with. But early stage startups should be thinking about those later stage rounds from the beginning to set themselves up for success right from the start. So that's what we're here to talk about today. Sadi, I'm going to throw it to you first. When you first started raising capital for your company, were you already thinking about those later rounds?
Yes, absolutely. I mean, I think one thing to note about the company you start is you should generally be aware is if it's a relatively capital-intensive company or if it's not a capital-intensive company. Aven, we're a very capital-intensive company. We provide asset-backed credit cards to consumers. We require large amounts of capital to spool up, and we'll require large amounts of capital to grow. And so from day zero, we knew that we needed to have an intensive pipeline of investors that we want to work with over a long period of time. So we were fairly selective from the early rounds, seed, Series A, and Series B, on the set of investors we would work with, so that we knew they could, work with us for a very long time and carry that company through. And so I think, yes, being fairly intentional about the investors you select in the early days can have, I think, a very positive impact in how you kind of are going to strategize your later stage rounds.
Mm-hmm. And there's also a very practical side to thinking about these later stage rounds from the beginning. Things like what your cap table is going to look like, how much capital you're going to raise, sort of what dilution you're going to be looking for, valuations at the later stage. And maybe if you guys want to talk about that and sort of how companies can approach these early stage rounds to set themselves up for success if all goes well reaching those later stage. Take it away.
So I sit at the later stage. So think about growth for us is a spectrum. It might meet companies in that 20 million plus revenue all the way through to hundreds of millions of revenue. So following in some respects off of where an IVP might sit and they might scale and grow, we might meet together and then we would perhaps take companies through to the public markets. For Context Generation is a dedicated sustainable investment platform which has just under 40 billion of assets, and we do private across a series of strategies all the way through to public. And so we actually can help companies also bridge that last step, perhaps if that's their aim, to go into the public arena as well. So I think meeting them early, I always say two years earlier than they need the growth capital is a great way to start the relationship, and it kind of echoes what you were saying on that stage.
Yeah, and I'll echo a lot of that. IVP, where we specialize, as mentioned, is in this post-product market fit stage. And you're really starting to look at, if you're a founder, like a pretty different set of investors, I think. So, and ironically, I think at these later stages, sometimes the rounds can actually go faster than you'd expect, or faster than you'd want, given theoretically there's a lot more to talk about in the business and a lot more data. And so it definitely helps to get to know those people earlier than you think you need to, so that by the time you're actually raising, you're talking to folks, one, that you probably get along with, two, who've already thought about your business a bit, et cetera. So definitely helpful to think about it well in advance.
Yeah, and sticking on that topic too, how should early stage founders think about approaching these late stage founders? I know you mentioned 2 years is a good time frame. Can they approach them too early? Sort of how do you build those relationships organically when, of course, the VC is going to know you are probably going to look for fundraising down the line?
So I think we did two things. One is we generally just believed in building like long-term relationships with investors of different types based on reputation, which I was a first-time founder when I started Aven. So I didn't know anything about startups or investors or venture capital, and so I learned a lot from Max Levchin and a few others that really helped guide me in the early days. I think the second thing that was really valuable to us is that at any given stage of fundraising, we always thought about what the next set of investors would be. To your point earlier, generally speaking, the investors kind of change, right? Change shape as you go into like later and later stages. So we try to build relationships in the previous round with an investor who really focuses on that kind of next stage round. And sometimes we would let them come in on like a symbolic check to really start establishing a relationship. Sometimes that doesn't really work for certain types of investors, but we'd build like a good relationship. They would see some data tapes. They would kind of get to know the company and get to know the management team, et cetera. And that may not feel very efficient in the early days, but it really helped us establish trust. And most importantly, I think it helped some of the later stage investors understand trajectory so that they can see a data point early on, and then they can get a second data point by the time we're doing that next raise, so they can see a trajectory for the company versus trying to learn everything all in one shot. I think in the very late stages, it probably changes again, where things are fairly quantitative and efficient. But I think between like seed, Series A, and as you go through like the B, C, D frames, I think having a longer term view on the relationships you build, whether it be structural with what I used to call symbolic checks, or just like getting to know each other and potentially sharing data with people that may not be the most efficient to share data with, can really help establish trust and trajectory for future investors.
Yeah, I was just going to say we always start with the research on the pocket of the market where we identify a company and meet them with context. So we call them roadmaps, and Generation's done 450 of them over the years. So that when we show up, even with you at a Series A or B, we've done the homework so that we're additive and hopefully it's a worthwhile conversation. And we're talking about the trajectory of how are we shifting a sector towards a more sustainable outcome. Like what do you care about? What's your real mission? And you lock on the things that are going to matter most. And then you will, of course, have a set of, well, what are your milestones? What does success look like to you as the entrepreneur is able to articulate that? You can come back and say, yes, you've been able to hit the milestones you set out. I remember, this is back in 2016, we met Toast. We ended up leading the Series C, or co-leading the Series C with LeadEdge. But back in 2016, Toast was still in an emergent digital-first solution for restaurants, starting with POS and moving with a vision to many other product opportunities. And it wasn't yet clear that they had pulled away from the pack. And so we spent time with them in the B, but then we ultimately leaned in the C. And that was great because we were front-footed, able to add value, had advisors and the context around the market for restaurant software, and even this added layer of thinking how efficiency could be driven into things like inventory management, food waste reduction, like a whole layer of things that they subsequently went on to tackle over the years. But it was starting that relationship early. Now things move. I think for you it's probably the speed and pace now is faster than ever, and so you really often can't show up from a cold start. You have to come up with a real prepared mind.
And one thing tactically for founders that I think, because the efficiency standpoint does matter a lot when your job is to actually build a business, but I think something that founders can lean on is their existing cap table and ask them like, hey, if now that I actually have a board, if I'm going to prioritize like 10 Series B or C investors to actually pick my head up and talk to, who would they be? And something we think about a lot is we have these earlier stage firms that we've served on a lot of boards with, and so they can actually say good things about us when we need to, when we were chasing Coinbase's Series B, we had worked with the entire cap table on other companies before, but again, it works for the founder as well, so you're allowing your cap table to pre-vet potential future investors.
100%. I think I couldn't agree more. Every round investor that we've had as a lead or a co-lead was pre-vetted by some previous investor. I remember when Coastal Ventures was preempting our B, I didn't know that much about Coastal Ventures or Vinod, and I kind of had gone through some news articles when they reached out about Vinod Khosla, and I'm sure he's incredible, and so we've done multiple rounds with them at this point. But at that time, I didn't know anything about Vinod, so I stumbled upon this article where he was fighting about some beach in California. Do you guys know about this? It's this hilarious article about Vinod Khosla and some beach kind of public spec he had with the state of California. And I was like, whoa, this is kind of crazy. And I was a little concerned. And so I remember going through this and going like, oh, do I really want to spend that much time getting to know Coastal Ventures? There's these kind of things I need to understand. And there was a few other firms who were also courting us at this time. And so I was trying to figure out where to spend time. And I remember I was driving back from work from Burlingame to Mountain View, and Max gave me a call. And he spent, I think, 45 minutes telling me that Vinod Khosla is the smartest human being Max Levchin spends time with every single quarter. And I was like, you know what? If Max thinks he's so smart, I should spend some amount of time with Vinod and get to know him. And so I dug into the actual court documents of this case between Vinod and California and the state of California to go like, okay, what's actually going on here? And so I remember reading through like, I don't know, this like 50 or 100-page court document. And at the end of it, I kind of came away going like, you know what? I kind of agree with Vinod, actually. I think he's right. And then I was like, all right, now let's go spend a bunch more time with Coastal Ventures, and they letter B, and they've since then letter D and our E. And so very grateful for that relationship, and it's come a long way. But a lot of it was indexed on Max really going to the mat, if you will, for Vinod, and saying he is one of the best investors Max has worked with, and I cannot agree more. So.
And you mentioned timeline a bit too, sort of in the post-COVID world we're in now. So I'm definitely curious, thinking about not only is the time between rounds quicker, but still, maybe it's changing now with the latest wave of AI acquisitions, but time to exit is longer. So rounds are quicker, time to exit is longer. How does that impact founders thinking of approaching this landscape, even second-time founders where the environment looks different now this time around?
I mean, my reaction to that is I think, if you look at it from the other standpoint of you're like fundraising according to certain milestones you're trying to hit, and I think the most tangible milestone for one fundraise is actually to get yourself to the next fundraise. And I think if you're thinking about it that way, the maybe potentially daunting thought of like, oh, how long will I be fundraising, or how long do I have to stay private, is a little less relevant, and you can keep it more of like a high-level strategy of maybe it manifests more in I should be a bit more conscious about like dilution if I have to raise a few more rounds, or like maybe I should be conscious of people are being very aggressive about trying to get me to raise money that I don't need, and I can be more conscious there. But again, I don't think you have to like super overthink it tactically at the round by round level, where ultimately it is, somebody's interested in your business, you're performing well, you're trying to unlock certain milestones and experiments to get to the next stage, and that really is the priority for you when you're thinking about fundraising.
Yeah, I do think this point about capital intensity is important, though, because certain businesses, you just may need to always be raising capital and or think forward 2 to 3 years as to what is your business need going to be, and you want to pre-fund that growth. For most companies that we see, if they're coming through into this double-digit million zone, which now is happening again faster than ever, we're looking for other features that relate to, are they selling, do they have a sticky relationship with their customer? Is it a diversified customer base? So we're actually focusing more on what we call like a business quality characteristics, which is not necessarily that these companies have proven that they have durable moats over the long term, but there's evidence that they've kind of block and tackled risk factors, right? So that they have more predictable earnings. And at the end of the day, we're coming in at a point where maybe we're investing, 50, 100, up to 150 million to help companies scale, because we know how the engine works. And it may be that they have to expand from product A to product B, or geography 1 to geography 2. So they are stepping stones, but you need to know what the engine is. Like, what is it that they sell? Who's repeatedly buying it? Because they have to have, a track record of economics that are visible, and retention curves that are at least emergent for the stage we come in. That is obviously very different at the earlier stages.
I think I would add that maybe because of the nature of the business that we're a financial services company, we kind of raised our first round and every single round on some relatively sometimes low fidelity, sometimes higher fidelity over the years operating model. And I think it's actually really important for founders to have like a reasonably good operating model in which, like an Excel file, which kind of has some set of inputs that drive some set of outputs for the company. When we raised our seed round, I actually didn't have a deck initially. All I had was an Excel file, and it was just one tab in the file of like, roughly speaking, this is the unit economics of this business, Max. And Max was like, he asked a bunch of questions, and on some set of cells, it was literally, I think, like less than 15 cells in height and like 2 cells in width. It wasn't much, but it was like almost every important metric in the company to date all derived from that actually file. And so sure, now we have like, a 20 megabyte operating model that you can like kind of move a bunch of variables and like see what variance causes what kind of effects. But I think having an operating model gives you kind of clear line of sight of like, okay, at this point I'm going to need more capital. Whether, in our case, it's either debt or equity capital that we raise both on either side. And these things, especially in a company like ours, are super high leverage. We do billions of dollars in debt financing, and we need to make sure equity fundraising is lined up with the debt fundraising so that we can support the debt as we grow. And so having like relatively high degree of, I wouldn't say precision, but confidence in like the major input variables and the major output variables, I think you referred to that as an engine, I think is really important for founders so they can understand, what do I need to do when? How much dilution will I need to take? I think it should be from relatively first principles of the business, and not kind of, just being yellowed out as you kind of, build the company out. I think the one other thing that was really helpful for us was we had a couple of very clear North Star target companies that we could learn from and see how they approached building a company. For us, that was, initially it was Affirm, Nubank, and there's this company in Russia, which I think is now kind of under or has gone through some troubles due to, a variety of reasons, called Tinkoff. And so if you look at kind of in the last 5 to 10 years or 10 to 20 years, these are like 3 kind of interesting companies that have been built in the space, and we could understand, okay, what were the kind of moments in which they had to raise debt or raise equity capital, and we can model or at least learn a little bit from those patterns. And I would argue that what was also really helpful was just studying the history of credit card companies. I don't come from a credit card company background, and so we just studied kind of the last known big credit card company, which is Capital One, and went like super deep into like, well, how was Capital One like capitalized as a company, and how did they structure their business? And we learned a bunch actually from them, which was really, really helpful. And so I would say, have first principles on like an operating model that is actually fairly crisp and helps you understand what you need to do when and what that trajectory looks like for the business. And then B, have like 2 or 3 metaphor companies that you can look at and go, okay, roughly they had to do these things and they're kind of best in class. So if I'm like roughly in that range of, milestone that I need to achieve in this time and raise this amount of capital for that, it's probably pretty reasonable as like as a metaphor to use. So those are 2 kind of tactical things that I think were valuable to us.
And plus, when we ask that question of entrepreneurs, is who do you admire? Who do you
Sure, yeah.
who do you want to look like when you grow up? Or if there isn't a metaphor or an analog, why not?
Yeah.
What is it that you're doing that is better than the previous models that have come before? And what hurdles would you need to overcome that others haven't? Yeah, it's great.
And that brings up something I wanted to ask about too, which is sort of expectation setting while still selling the dream. If you're an early stage founder and you're starting to engage with potential late stage VCs that you're hoping to work with later on, you want to give them a vision that gets them excited to invest in 3-4 years. But you also don't want to be like, hey, we're going to have expanded into X category by then in case that doesn't happen. Then, of course, VCs know companies pivot, things take longer than people want. But how can founders think about sort of like towing that line, selling the vision, selling what they're going to do as they're meeting these later stage investors, but also making sure it's realistic enough so when they check back in, they weren't wildly off?
I mean, I think it is this, if you can do it on a page, it's better, because I like the concentric circles of, your core market, your serviceable, and then as you build into broader addressable market, like the ways in which those circles could build, because you can actually change the names on those circles. If you start with again, a product that is in payroll, and then you think you can move into other aspects of an SMB's workflow. So we're investors in companies like, a Service Titan. Service Titan started in residential. It's now a public company, but they've now earned the right to move into C&I, commercial and industrial, right? So these circles, I think, can be laid out very clearly at the beginning, and then say, listen, we're going to modify what size they are, our right to win, and then the execution capabilities that we have to go after them over time. But let's keep it on a page, because I think simplicity helps on that alignment as well.
I would also offer the vision always matters. So I don't think it's like at the early stage you're just pitching a vision and you're almost afraid that the vision doesn't play out by the Series D or the E. It's like, you're probably still pitching the same vision at the Series D and E. You might even be pitching a bigger vision, right? So I don't think you need to like necessarily be afraid of like overcommitting anything to an investor. Maybe, yeah, I like the tactic of you don't have to promise them numbers, like specific numbers very early on, right? But I think there's always some talk track of, hey, we talked to you 12 months ago, this is kind of how we saw the future, and now we see an even bigger future, and we've like chewed off these 2 bits. Now we'll have to move on to these, and that's probably not really going to change in the next 5 years.
Yeah, I think I would. I may have some slightly controversial opinions on this. One is I'm not like a really big believer in pivoting. Like I was a product leader at Facebook for a long time, and I would generally hold the product team to be like have a tight thesis and deliver on the thesis and know exactly what risk you're taking on the thesis. So there's roughly two kinds of risks we take as founders. We either take what I call like market risk, or we take execution risk. So a good example of market risk is, a company like Facebook, and I used to joke at Facebook a lot that like, it'd be really hard for me to build Facebook because I really dislike taking market risk. Where it's relatively easy to build Facebook, but it's really hard to tell Facebook is going to be huge, or like what the TAM is for this product, or how many people want to use this product. The converse is a company like Tesla, which is reasonably low market risk actually, but is very high execution risk. If you were to tell me, like 20 years ago that I'm going to give you a car that is never going to need any gas, will drive itself, and costs roughly the same amount as like an expensive Honda Accord, you'd be like, give me 10, like take all my money. There's no real question that you'd want one. And that's execution risk. And I come from an engineering background, so my general take on it is like, I love building products that only take execution risk and don't take product risk. And so, to your point around the vision, I think if you need to pivot, something has, I think, gone wrong, and you should like revisit the kind of base set of assumptions you're operating under. We've been fortunate that we haven't needed to pivot. I get like sometimes you need to pivot, but you should look pretty hard on like, okay, what part of my thesis is actually incorrect? And you may need to change the whole ballgame versus just changing one little part of it. And I think that's okay. Like, like I think early stage startups especially are thesis driven. You're making a hypothesis about the world, and there is somewhat of a scientific process you're going through, whether it be with capital, with engineering, with product, that you're trying to prove or disprove this thesis. And I think ideally your thesis is well grounded in a set of like very deep first principles that should work. And in the case of, for example, in our case, our thesis was we can reduce the cost of capital for consumers by 50% by moving them from unsecured debt to secured debt. It's a reasonably like kind of crazy thesis when you think about it, because that's the largest change in the cost of capital in American history. But when you actually double click into it, you go, well, the cost of an interest rate on a credit card is 25%. The cost of interest on a home equity product is 10%. So if we can take 70% of homeowners actually revolve on their credit card debt. So if we can get every single homeowner to click a bunch of buttons and move their unsecured debt to their secured debt, it should reduce their cost of capital by 50%. And that's like a pretty, like, it's not like rocket science. Right? Then the question becomes, well, how many button clicks can you make that thing? And if you make it a sufficiently small number of button clicks, then a lot of people will do it. And so that becomes then like a pure execution risk problem, where your question is, can you or can you not make the number of button clicks as small as possible? And so then that's the research you should do, in my opinion, before you start the company, where you should go super deep into the space and go like, is this actually possible or not? And there's going to be some margin of error on like, at some point there's just theory versus practice, and you could theorize only so much. The other thing that I would say practically is, this is like reasonably, I think, commonplace in most kind of high quality product companies or product organizations in big or startups or big tech companies, is we generally require our teams to have goals that are set with a confidence interval. So we express a goal, like whether it be a revenue goal or account growth goal or a product launch goal, in the context of what probability is your confidence level. And I think this is like really important, because you want to express a goal with a confidence level attached. And my intuition is like, most of the time, I think good companies will operate their teams, if they're running like an aggressive team, at a P50 goal. Now they may express a P80 confidence level to investors or external parties, but internally they may be running a P50 goal. Like a common trope at Facebook was most teams would run on P50 goals, and if you came into like a senior level review, quarter after quarter or half after half, hitting your P50 goals, would all look at you and go like, hey man, stop sandbagging. You have to hit you should miss some of your P50 goals. If you're not missing a bunch of your P50 goals, they're actually not P50 goals. Whether or not, and I think being explicit with and intentional about how you communicate your goals and what you're looking to hit with a confidence interval, I think allows everyone to be kind of on the same page of like, yeah, that's a P50 goal, that's a P80 goal, and then investors, your board, I think your executives and the team can all align on, yeah, that's kind of all of the information that is available for us to make this decision today, and this is how we're expressing it in the most clear and concise possible way. So I'm a big believer in like expressing values with confidence levels versus just expressing values by themselves.
And I think one of the other things to think about too is we're talking a lot about like what to talk to potential later stage investors about. But is there anything that companies should avoid when they're talking to later stage investors, and not avoid in necessarily like a predatory or a negative way, but just like things you don't need to share? Like things companies might want to keep to themselves at the early stage just in case things do end up sort of changing as they continue to build. And I will also note we'll be opening up for Q&A in about 3-4 minutes. So if you have a question in mind for the panelists, we've got 2 microphones in the aisles here, so feel free to just line up and we will call on folks as people have questions. But yeah, what should companies avoid talking about?
I'll pick what I think they sometimes avoid, which I wish they didn't.
That's a good one.
Answer a riff on that. Again, at growth stage, team is a huge component of value because it's been assembled, it's probably been reassembled, and then perhaps assembled again to be fit for purpose for scale. And I really think you have to go in with your growth stage investors, eyes wide open of the either gaps that need to be filled. Usually the gaps have been filled, but you may need to still upgrade. And I wish that more companies were front-footed on talking about what are going to be the paths for either senior managers or next level to step in and help them scale. Because I think the 50 to 500 zone is a very different stage of company, right? It is just a classically difficult set of steps. I mean, every stage is difficult, but where you're going to have folks who probably have been there, done that in other places, but not in a place where they had so much infrastructure and support that they're not nimble. There is a benefit of having worked together with folks outside and prior, but not too many people who had only worked outside and prior, so that they're just taking the playbook from a prior company to map it, right? So that's the discussion and dialogue that I think in rushed processes often gets shortcut. And the importance of management quality and culture and alignment and board and governance should not be underestimated, because that is the thing. If you're now going to 500 million plus of revenues and you have an aspiration to be a listed company, that you just have to get right, and you need people to be aligned and making the decisions before they become problems towards on talent, on board, on diversity of board, on independence in the boardroom and beyond.
This is like negotiating against myself a little bit by giving this piece of advice, but you don't have to share your numbers with investors when they're not fundraising. So I think why founders are so transparent about that is before IVP, I came from early stage investing, and at seed and A, you just tell people everything. You know what I mean? And I think that's totally fine, and I think that's a habit that gets built. And so when they start to transition into these growthier rounds, they're like still doing that. But if you're not fundraising, you don't have to tell them any numbers. You don't have to tell them your year-end forecasts. Like, yeah, you're just like catching up. You should talk about the business.
And ask them for help, because actually they have a lot of resources. Like investors have a lot of resources they can bring to you, and so I think it's this opportunity. They have advisors, they have past playbooks, they have seen folks move through that next stage of growth, actually flip the table and actually spend time asking, what those investors could do incrementally on in your cap table.
I think that the last point I think is what I really believe in a lot, where most of the time in any given business, any given team, there's always some set of things that are going really well and some set of things that are not going so well. And if you're an executive or a CEO of a company, you generally want to solve the things that are not going well. So my kind of general intuition around this is that I actually think you should share the problems of things that are not going well, or share the problems with people that can help you solve those problems, because that's their value to you. And if there's some set of things that are obviously sensitive around like information and financial disclosures, et cetera, that as you kind of grow as a company, you become more sensitive to. But I don't think you gain a huge amount by hiding like the big problems you're trying to solve as a company, because you're probably going to need help to solve them anyways. And the more people that you can elicit help from, the more likely you're to be able to solve them. Now, with using some level of judgment on whether or not this person, A, has the motivation, and then B, has the competency to actually solve it for you. If they don't have the motivation or the competency, then sharing it to them is not useful. But if they seem like a reasonably motivated person and they seem competent in this specific domain of this problem that you're trying to solve, then I think sharing with them is generally valuable. We probably come from a company and a culture where we don't share much at all externally outside to our investors. We mostly have insider rounds a lot, and so we generally are probably more closed door than many other companies to some extent. But amongst our investors and amongst our board, we're fairly aggressive on like, these are the top 3 problems. This is what we need help on. We need you to help on these A, B, and C things because they want you to succeed. So I think if you have great investors, they really, really want you to win as well. So not eliciting their help is kind of just shortchanging yourself, in my opinion.
And I definitely wanted to ask you, Zaya, about this early stage investing experience. And were you surprised by the differences with what you were looking for when you're talking to companies when you made the switch to later stage? Like, just to sort of paint a picture for folks who are thinking about starting to raise these subsequent rounds, how different was it for you to make that switch to talk to companies in this way?
Yeah, to be honest, I don't think it's that different. Like maybe there's a bit of a conception there in the market, but if we're talking about seed A, B, C, D, E, F, G, whatever, it really is a spectrum of what's available, not necessarily what investors are paying attention to. So I think the misconception is maybe like, oh, at seed and A, they just care about my story and my team and whatnot. And then once we get to the later stages, all they care about is metrics. I think the reality is it's more that they care about everything the whole way. It's that there aren't that many metrics to look at seed. And probably at B and C, if anything, as I mentioned, the team and the storytelling is probably getting better over time. So then that's almost like a given, and now there are metrics to dig into. So probably the entrepreneur feels like, oh, they're asking a lot of questions about my metrics. It's like, no, it's because you've done a great job storytelling. Now, like, there are just other things to dig into. So I don't actually think it's that different, or there's like a different lens that investors are placing on the companies.
Mm-hmm. And remember, we can take those questions unless everyone in here is like pre-IPO, everything's gone really well. That's where we're all at? All right. Well, the other thing, we talked about this briefly at the beginning of the chat, but definitely think this is something that's really relevant, especially in the current moment. We have come out of the 2021 period where valuations were going crazy and some early stage companies sort of set themselves up for a very interesting valuation trajectory for later stage rounds. But we're also in the age of AI, where companies are using less to get to these milestones than maybe they were 4 years ago. How do companies even start to think about valuations in the current environment at the early stage to, of course, make sure they don't set themselves up to be too expensive or, on the flip side, too cheap when they get to the later stages?
Do you want to start the early stage and I can build?
Sure, yeah. I think, and because it's probably where you're going, there's this thing called multiple compression, and it kind of matters more as you go along. But I do think at the earlier stages, you can feel comfortable being opportunistic about what is being presented to you in the market, right? Like when rounds are not entirely based on fundamentals, like the price that somebody is willing, or whatever an asset is worth is just what price somebody is willing to pay for it.
Right.
And I think you just let the market speak for itself. And then, yeah, as you get closer and closer to IPO, and the public markets have a lot of more like transparent metrics that they go on. I can let you take this part.
Well, I just think at the end of the day, the public markets provides a mirror, and you can't say that that doesn't exist because it is there available every day to look at, and therefore you have to see how you can go from, with the capital you need to raise, to an exit where you're going to be put on a multiple with the basket of similar business models. Like, it's almost impossible to say that that won't apply to you over the long term. And so, again, because we run a large listed equity strategy, and we cover 120 of the best global companies, and we have also helped private companies like the Toasts and the Service Titans and the Remitlys and the Asanas and others go public. It's this kind of the hygiene and the discipline of just looking at what those public best-in-class, leading enterprise SaaS or SMB SaaS business models are trading at, and then saying, well, I now need to create value between today and when the exit is, where I believe we'll be at X hundred million of revenue or billions of revenue, and this will be the multiple. Like, I can see that this investor coming in is getting a 4 times, a 5 times, a 3, whatever the risk band is that you're in, and there has to be headroom. And so I just think if there's not headroom, you're going to set yourself up for a really difficult journey. And we've all seen this in overcapitalized companies, but companies where just the valuation that was taken, unfortunately, didn't give the next investor headroom, especially with higher interest rates and slowing growth and maybe cost restructurings. And that just isn't fun. And that actually will can put businesses out of business. So I think the alignment is really important. And then even looking at your cap table of who came in when, and then what type of partner do you now need to help you scale and grow? So from the entrepreneur's perspective, you'll have representation from folks who might have a certain in price, but you now want to bring in a later stage investor who you want them to win with your early stage investors and them to be your biggest supporters 5 years, 10 years from now, and making that your goal, because that will make you highly successful.
I think from a founder standpoint, the pricing question is always kind of on everyone's mind. My intuition is there's roughly only 2 broad models of pricing. One is competitive, and the other one is first principles. If first principles pricing is actually really simple formulaically. It's a sum of all future cash flows your business will generate, and almost all businesses will eventually kind of converge to that. And at some point, all businesses will eventually trade at 10x P/E ratio. Is kind of the joke that I always have for everyone. And in between, to get to that point is obviously to survive long enough to get to that point, and the world is mostly not rational on that journey. And so that's where competitive or market pricing comes in. I think in general as a founder, I almost never talk about pricing on a round. I just let the market kind of determine the price, and if there's multiple bids, they'll let the bids kind of speak for themselves. And you should kind of generally, I think, let the market speak for its price. I think there are times where I've definitely gone through where there was preemptive round offers, et cetera, and that didn't clear a hurdle that I wanted to hit, given either where I was in the business today or where I thought I could be in the business without raising incremental capital. In which case the question becomes one of well, look, I don't want to raise until I hit this milestone. If you want to preemptively give me an offer before I hit that milestone, let's talk about how much risk you're taking and how much risk I think there is in there. And if you're willing to pay for the risk and get first in line on the dib, right? So that's I think a very frank and real conversation. And I won't name names, but I've had very frank conversation with investors where they wanted to come in at a certain price preemptively, and my kind of point of view was that why don't we just wait 6 months? Yeah. Then I think you will be more comfortable with the price that I want to be at, because I'll have hit some milestones, and if I don't deliver on those milestones, then it kind of a moot point anyways. And this is pre-launch of a product, right? So there was a lot of risk that the investor was going to take. And I wanted to be transparent with them to be look, this is a consumer product. I've been building consumer products for 20 years of my life. And I think the person asked me, super intelligent person, was well, what do you think is the probability of this thing working or not? And I was 20%, 25% of it working. And this person was wait, that's really low odds. And I was it's a consumer product. If anyone ever tells you a consumer product pre-launch has more than 20% odds, they're full of crap, and you shouldn't believe anything that they're selling. And look, I have no kind of ego around what is a reasonable price for this business. It's just a function of I think with the capital that we have, we can get to this milestone. In which case, let's talk about a round at that milestone. And I think that's a more healthy way of having the conversation versus kind of just ego battling some number on a phone call or a term sheet. Because it effectively is, to you guys' point, at some point, at least for us, we'll want to be a publicly traded company and build the company in public, over some long period of time, in which case we will be subject to the pressures of a publicly traded business. And I think we can't be delusional about some price that we may or may not be able to get in the short term that isn't going to be able to withstand public pressure. The second piece I would say is that we're constantly tracking 2 or 3 companies in public markets that we think are reasonable comps for us. Especially in later stages, this becomes increasingly important. And you should be able to articulate why, if you want a higher multiple than that company, why you deserve that higher multiple. Is it because of your higher growth rate? Do you have a higher margin? Do you have more COGS efficiency? What is the underlying kind of driver or mechanic or physics of your business that is superior to that business. And generally speaking, there is one or two things. And for us, it's usually our growth rate is higher than, let's say, some comparable public company. Our risk is lower, et cetera, but you should be able to, I think, articulate that reasonably confidently against some publicly traded company that exists that is like metaphorically similar. And I think there are very few companies that can be built that don't have some kind of metaphor of a publicly traded company. There's probably some, like maybe 20, 30%, but most companies have some metaphor that you can look at and say, yeah, that's how they trade, and so this is like the drawdown derivative of that trade to like my business, and here's why I'm different, and here's why I deserve some higher or probably higher multiple is what you're going to be arguing for.
And so unfortunately, we did run right up to time. If you did have questions, I'm sure our panelists would be happy to answer them after. But for now, that's going to be all from us. So join me in thanking the panelists today.